A company just became a unicorn, valued at $10 billion. But here's what investors aren't telling you. Their entire business model depends on people staying broke. The more debt their customers carry, the more money they make. So how did debt become the foundation of a $10 billion industry? For the last decade, a shadow industry has been quietly reshaping how Americans borrow money. These aren't traditional banks. They're fintech platforms, buy now, pay later companies, and alternative lenders. And they've collectively reached a $10 billion valuation while operating in plain sight. The mechanics are simple but brilliant from an investor's perspective. A customer needs cash. They're denied by traditional banks because their credit is bad. So they turn to these platforms. They get the loan instantly. No questions asked, no credit check that matters. The platforms make money three ways. First, they charge the borrower interest rates between 30% and 400% annually. Second, they sell the debt to investors as securities. Third, they collect data on every transaction, every payment pattern, every financial weakness. That data becomes a product sold to other companies. The math works like this. If you borrow $5,000 at 100% annual interest, the lender makes $5,000 in interest alone. But if they can repackage your debt and sell it to an investment fund, they make money again without holding any risk. They've become a middleman between desperate borrowers and wealthy investors hunting for yield. This is the architecture of the $10 billion industry. It's not built on helping people. It's engineered to profit from financial desperation. Three factors collided in 2015 that made this industry explosive. First, the Federal Reserve kept interest rates near zero. Traditional banks couldn't make money lending to safe borrowers anymore. So investors started hunting for higher yields. They found subprime lending. Suddenly, a 100% interest rate didn't look risky. It looked like opportunity. Second, mobile technology went mainstream. A borrower no longer needed to visit a physical location. They could apply for a loan on their phone in 90 seconds. This removed friction. It removed shame. It scaled the business from thousands of transactions to millions. By 2022, alternative lenders had originated over $200 billion in loans. That's 200 billion reasons to keep growing. Third, venture capital realized this wasn't a small opportunity. It was a market that could touch every American with bad credit, no savings, and a financial emergency. There are roughly 50 million Americans living paycheck to paycheck. Each one is a potential customer. Each one represents lifetime value. One early investor saw this and poured $300 million into a single platform. That investor made 40 times their money in 5 years. But here's what happened next. These companies started looking desperate for growth. They realized their core customer base wasn't growing fast enough, so they pivoted. Instead of just lending to the desperate, they started rebranding debt as convenience. Buy now, pay later became a weapon aimed at middle-class Americans with decent credit. The pitch changed from emergency funds to lifestyle purchases. And it worked. Suddenly, there were 15 major buy now, pay later platforms fighting for market share, each one offering 0% interest for 6 weeks, knowing that most customers would miss the deadline and get charged late fees. The industry crossed $5 billion in originations, then $10 billion, then $100 billion, all while the platforms remained privately held or barely profitable. How? Because they were growing revenue faster than they were acquiring customers. That meant they were extracting more money from each customer. They were making the debt stickier, more recurring, more profitable per person. Here's what the financial media won't tell you. This industry doesn't have a business model problem. It has a moral architecture problem. The entire system is optimized to maximize lifetime debt, not lifetime value. Consider the math from a customer perspective. You use a buy now, pay later platform to purchase $800 in clothing. The store gets paid immediately. The platform fronts the cash. You're supposed to pay 4 payments of $200 over 6 weeks with 0 interest, but you missed the second payment because you forgot. Now you're charged a $30 late fee. You're also charged a $20 processing fee. Your $800 purchase now costs $850. If you miss another payment, the fees compound. Some platforms charge up to $100 per missed payment. The annual percentage rate on these fees works out to 900% or higher. That's not lending. That's a trap disguised as convenience. The platforms know exactly what they're doing. Their data scientists model payment behavior with stunning accuracy. They know that a customer with one late payment will have more late payments. So the algorithm shows that customer more products, more temptation, more opportunities to borrow. The platform is literally trying to get you to miss payments because missed payments are profit. This is why the industry became a $10 billion machine so quickly. They're not just lending money, they're systematizing poverty. But there's a second hidden cost that matters more. These platforms have avoided regulation that would apply to traditional banks. They operate in legal gray zones. Some states classify them as technology companies, not lenders. Others have no rules about APR caps. This regulatory arbitrage was the gasoline that fueled growth. A traditional bank can't charge 900% APR, but a fintech platform operating in certain states can. The industry weaponized the regulatory lag between innovation and law. So why did investors pour $10 billion into this? Because it works. The top platforms are growing revenue at 100% year over year. They're reaching profitability, and they've created a moat that's hard to cross. Every loan originated becomes data. Every customer interaction becomes a training signal for their AI models. These models predict who will borrow again, how much they can borrow, and when they'll miss a payment. The company that has the most data wins. One unicorn in this space just filed for IPO. Their prospectus is a masterclass in how to hide the dark side of a business model. They emphasize growth metrics, customer acquisition rates, loan originations. They buried a single sentence mentioning that their average customer has missed at least one payment. Buried, because that sentence reveals the entire thesis. The debt industry is not a startup story. It's a wealth transfer story. Wealth moving from people with bad luck and bad credit to people with capital and risk tolerance. So here's the answer to the burning question. How did debt become a $10 billion industry? Because debt, when packaged as technology, when automated through AI, and when sold to a population desperate for cash, becomes the most predictable, scalable